Welcome to the Deep Dive. Our mission today is to take some really dense material. We're talking recent fiscal year 2025 reports, Q1 FY26 outlooks for a major tech firm, and really boil it down for you. Sharp, clear insights.
Exactly. We're aiming to get past the headlines. This company is making huge bets on AI, automotive, IoT, but they're also juggling some serious legal issues and, well, geopolitical risks. We need to figure out where the real growth might come from and what could actually stop it.
Yeah, and the source stocks are no joke. We've got the Form 10-K for the fiscal year ending September 28, 2025, plus November guidance, conference call bits. It's heavy stuff.
It really is. If you want the ground truth on how a giant like this manages R&D and risk, this is it.
Okay, let's unpack this.
Right.
Let's start with the big picture financials. FY25 looked pretty strong on the surface. Total revenue hit $44.284 billion. That's up quite a bit from $38.9 billion the year before.
It is, and that growth tells a story. Pretty much all of it, $5.1 billion in growth, came from their equipment and services side. That's the QCT segment, the integrated circuits.
Okay, QCT drives the growth. What about the other side, the licensing?
QTL, which is, all their core intellectual property licensing, the 5G, 4G patents that stayed almost completely flat, around $5.58 billion.
The products are booming, licensing is steady but not growing much.
Precisely. It shows the diversification push into products is working, at least on the revenue side. But that reliable licensing profit engine isn't really expanding right now. It's mature.
And looking ahead, they gave guidance for Q1 of FY26.
They did. Revenue guidance between $11.8 billion and $12.6 billion overall. And again, you see QCT being the heavyweight, $10.3 to $10.9 billion of that range, with QTL projected at $1.4 to $1.6 billion.
Got it. Now, buried in the non-operating items for FY25, there's this massive number, a $5.7 billion hit in Q4. It wasn't cash out the door, but it hammered the official net income. What on earth was that?
Yes. That was all about tax changes, specifically the One Big Beautiful Bill Act, the OBBB, enacted back in July 2025. Because of that law, the company expects to fall under the Corporate Alternative Minimum Tax, or CAMP, starting in fiscal 2026.
Right.
And accounting rules basically forced them to take a huge one-time non-cash charge right then in Q4 FY25. It was to set up a valuation allowance against their federal deferred tax assets.
So let me get this straight for our listeners. This wasn't money spent. It was an accounting move anticipating higher future taxes because of a new law, a massive paper loss.
Exactly. It's a forecast on paper hitting the books now. It obviously made the GAAP net income for the year look much worse, but cash flow wasn't directly impacted at that moment.
How did the market take a $5.7 billion non-cash adjustment? Seems like it would spook people.
Well, it was definitely a jolt to the GAAP number, no doubt. But I think analysts mostly understood it was a mandatory accounting thing tied to policy changes, sort of unavoidable.
And there's a silver lining, tax-wise, going forward.
Yeah, the projection now is that after this big one-time adjustment, their ongoing future cash tax rate should actually settle into a pretty decent range, maybe 13% to 14%.
Okay, so despite that big accounting hit, the underlying business must still be throwing off cash. They returned a lot of money to shareholders in FY25.
Oh, absolutely. $12.596 billion returned in total. They spent nearly $8.8 billion buying back their own stock and paid out another $3.8 billion in dividends.
That's serious capital return.
Shows confidence, I suppose.
Definitely signals they believe in their own valuation and future cash generation, even with these shifts happening.
All right, we've got the financial baseline, strong product growth. That big tax adjustment is understood now. Let's pick it to strategy. QCT is growing, so where's the innovation effort focused? What's supposed to fuel this move beyond just phones?
Well, they're certainly not neglecting mobile. They just launched the Snapdragon 8 Elite Gen 5. Big focus there is their custom third-gen Qualcomm Orion CPU.
Orion, that's the tech from the Nuvia acquisition.
That's the one. They're calling it the fastest mobile CPU ever. Plus, upgraded NPU for AI, better GPU. It's aimed squarely at those next-gen AI smartphones. Okay, so still strong in mobile. But the buzzword seems to be diversification, especially automotive. It feels like they want to be more than just a chip supplier there.
Oh, it's much more than that now. Here's where it gets really interesting. They're pushing the Snapdragon digital chassis platform hard. Think connectivity, cockpit electronics, driver assistance, the whole digital foundation of the car.
And they're landing deals with big names.
Yeah, look at the collaborations. They're jointly developing the automated driving software stack with BMW Group. partnering with Valeo to push software-defined vehicles forward, focusing on scalable ADAS and safety systems.
Software-defined vehicles.
Yeah.
Meaning the car's functions are increasingly controlled by software, upgradable over time.
Exactly. And they want their platforms to be the hardware and software enablers for that. We're also seeing their Snapdragon cockpit platforms in new electric Mercedes-Benz models, powering those fancy AI-driven displays and experiences.
Those displays, driving assistance, connectivity.
And even deeper AI integration. They're working closer with Google Cloud and Harman on what they call agentic AI in the car, basically smarter, more proactive assistance. It's a comprehensive play.
Beyond automotive, I saw mentions of some very specialized products too, like wearables with satellite support. What's that about?
Right, those show the breadth they're aiming for. The Snapdragon W5 Plus and W5 platforms for wearables now have NB-NTN satellite support.
NB-NTN.
Narrowband non-terrestrial network. Basically, it lets low-power devices like smartwatches connect directly to satellites, so you can get messages or location data even if you're way outside cellular coverage. Think remote hiking, specialized tracking.
Huh, interesting niche. And something about RFID in a mobile processor.
Yeah, the first enterprise mobile processor with RFID fully integrated. Usually you'd need separate chips for that. It simplifies device design for logistics, retail, that sort of thing.
Okay, so they're pushing core mobile tech, going deep into automotive systems and hitting specialized niches. What about the future network tech itself? 5G advanced, 6G.
They're definitely looking ahead there. 5G Advanced is about enhancing current 5G, using AI, maybe bringing in more satellite communications. And their vision for 6G, well, they see it deeply integrating AI, sensing capabilities, maybe even digital twinning right into the network fabric.
That sounds ambitious. Okay, innovation seems strong, diversification is happening, but the 10K is also full of risks. Let's turn there. The biggest shadow over the QCT segment seems to come from one of their biggest customers.
You mean Apple? Yes, that's the elephant in the room. Vertical integration. The report is explicit. Apple has started using its own modems in some newer smartphones, not Qualcomm's.
And they expect that trend to continue.
They state clearly they expect Apple will increasingly use its own modems going forward, and they directly warn this will have a significant negative impact on QCT revenue, results, and cash flow. There's no sugarcoating it.
Wow. So this diversification into auto and IoT we just talked about, it's basically a race against Apple dropping them.
That's a very accurate way to put it. Can they ramp up these new growth areas fast enough to fill the hole that Apple's departure will inevitably create in their handset chip business? That's the core strategic challenge.
A high-stakes race indeed. Okay, shifting from competitive risk to geopolitical. Their operations look very concentrated geographically.
Extremely. A lot of revenue comes from Chinese phone makers and sales into China. That carries its own risks, obviously. But the really critical point is the supply chain.
Manufacturing.
Yes. Their key suppliers, the foundries making the chips, are primarily in Taiwan and South Korea. The report directly flags the risk. A major military conflict involving China and Taiwan could severely limit or even stop their chip supply from Taiwan.
That sounds potentially existential for the business model.
It's a massive vulnerability, and it's right there in black and white in their risk factors.
And we've already seen trade policy bite them, right, with Huawei.
We have. The U.S. revoked their license to sell certain chips, 4G and others, to Huawei back in May 2024. So that revenue stream, gone. Dried up completely due to export controls. It shows how vulnerable they are to these policy shifts.
Okay, let's talk legal battles. That custom Orion CPU, the core of their new performance push, that was subject to a major lawsuit with ARM, wasn't it?
It was. ARM sued them over the Nuvia designs used in Orion, claiming they didn't have the right license. It went to trial late last year, December 2024.
And the outcome?
It was actually pretty favorable for Qualcomm, mostly. The jury found Qualcomm did not breach the Nuvia license agreement it acquired. And crucially, they found that the new Qualcomm CPUs using those Nuvia designs are covered by Qualcomm's existing license with ARM.
So a win.
A win on those key points, yes. Although, interestingly, the jury couldn't agree on whether Nuvia itself had breached its original agreement with ARM before Qualcomm bought them.
Okay, so mostly a win, but still some ambiguity. And is it over?
Not quite. The court upheld the verdict favoring Qualcomm and Nuvia. However, ARM wasn't satisfied and filed a notice of appeal on October 1st, 2025.
Ah, so it's still ongoing. The legal fight over the tech powering their fastest CPU claim isn't settled yet.
Exactly. There's still uncertainty hanging over that core technology while the appeal plays out, and that's just one case. We shouldn't forget the constant background noise of legal challenges around their QTL licensing business debates over FRAN terms, royalty rates, the royalty base. That's always simmering.
Right. The licensing model is perpetually under scrutiny. Okay, finally, let's look inside the company. Corporate governance. They made an interesting shift in compensation, moving away from cash bonuses for leaders.
Yes, for their broader non-executive leadership team. They decided to replace the usual annual cash incentive awards for fiscal 2026 and 2027 with a 2-year equity award instead.
Why do that? Seems like a big change.
It feels very strategic. When you're undertaking a complex multi-year pivot, like heavily investing in automotive, you need your leadership locked in and focused on the long term. Tying compensation to equity over 2 years rather than annual cash aims to do just that.
So it aligns their payout with the success of the diversification strategy over a longer period and helps retention during a risky phase.
That's the clear intention. It ties their fortunes more directly to executing the strategy and delivering shareholder value over that crucial transition period.
And speaking of accountability, what happens if the financials themselves turn out to be wrong? Their clawback policy looked pretty strict.
It is quite rigorous. If the company has to issue an accounting restatement, whether it's a major big R restatement or a smaller little r correction because of material non-compliance with reporting rules,
Then executives have to pay back bonuses.
exactly, they have to recoup incentive compensation that was paid to key officers.
How far back does that look?
It covers the 3 full fiscal years right before the date the restatement was deemed necessary, so it has real teeth.
And how do they get the money back?
They can cancel outstanding awards like unvested stock or demand direct repayment. And importantly, the company is explicitly prohibited from covering the officer's loss, no indemnification. It's meant to be a strong deterrent against any kind of financial reporting gamesmanship.
Okay, quite the detailed picture. So what does this all mean?
Well, we're watching a tech giant trying to navigate a really tricky path. They've got proven strength in their core chip business, shown by that strong FY25 QCT growth, but that success is happening right alongside 2 massive risks casting long shadows.
Apple going its own way and the Taiwan supply chain concentration.
Precisely. The known, almost certain future revenue hit from Apple pulling back, and the ever-present geopolitical risk tied to their manufacturing footprint in Taiwan. Winning that ARM appeal is crucial for their tech story, but ultimately their future hinges on whether auto and IoT can grow fast enough to offset that Apple loss, all while managing that huge supply chain vulnerability.
And that Taiwan risk isn't just abstract. You mentioned the physical assets there.
Right. The 10K notes $3.4 billion in long-lived tangible assets, factories, equipment, etc., located outside the U.S., and most of that is concentrated in Taiwan and the surrounding Asia-Pacific region.
Okay, here's a final thought then. They've publicly stated long-term revenue goals, aiming for certain targets by fiscal year 2029. Given that huge $3.4 billion physical presence in Taiwan, providing the critical foundry capacity, how reliable can those long-term commitments possibly be against such a concentrated, high-stakes geopolitical and operational risk right there in that region?
That's the tension, isn't it? The ambition versus the fragility. How they navigate that is going to define their story for the next decade.